So what are some of the other common pitfalls or mistakes investors make during this 1031 and end up paying taxes even though they're trying to avoid it?
Great question. Really great question, Vinki. So vacation property is somewhere that I see where things can go awry and something to be very cognizant of while you're going ahead and performing an exchange.
Mhm.
I have people ask me all the time, does vacation property qualify towards a 1031 exchange? And vacation rentals will qualify for 1031 exchanges if they meet the rules of the revenue procedure in 2008/16, which is going to be the property needs to be rented out for at least 2 years before its sale. So it needs to be Airbnb, verboed. You need to have a tenant in there. Whatever that situation looks like, it needs to be rented out for that 2-year holding period.
Mhm.
And then the replacement property needs to be rented for at least 2 years after its purchase.
Mhm.
And the most important part here, personal use cannot exceed 14 days or 10% of the days rented out each year during this 4-year period. So very important that one, either they use the property very sparingly. They still can vacation there. That's okay. But they can vacation there more than 14 days a year. So very important, if you do plan on using it personally, you do so at a very select time in very minimal circumstances, or 10% of the time it's rented out. Say you rent it out quite frequently.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of opportunities with you and for you. And today I have my good friend, Paul Hurst with me. Welcome, Paul, to the Real Estate Vibe Show.
Oh, thank you very much, Vinki. I really appreciate you having me on here today. I know you've had some very famous guests in the past, and I really enjoy your content. So thank you so much.
Thanks for being here. A little bit about Paul. Paul is a senior business development associate at Equity Institutional Services, where he helps syndicators and investors enhance their wealth and cash flow through self-directed IRA and 1031 exchanges. Paul brings a diverse background spanning construction, IT, and education. He holds degree in business, sports management, and masters in strategic leadership. Oh my God, I love that. So many degrees. So today our topic of discussion is very interesting. It's going to be maximizing wealth with self-directed IRA and 1031 exchanges. In this episode, we'll be diving into the powerful wealth building tools of self-directed IRA and 1031 exchanges. We'll discuss how these strategies can help you grow your real estate portfolio, maximize tax advantages, and boost your cash flow. This is actually a roadmap to smarter, more flexible investing, right? So let's start with this question actually. Can you explain what self-directed IRA is and how is it different from the traditional IRA?
I would absolutely love to, Vinki. So in regards to a self-directed IRA, it's actually not a special type of IRA account. It's very similar to any other IRA account held at any other institution. It has the same exact rules that were established in 1974 with the ERISA Act. What really is going to differ when it comes to a self-directed IRA is going to be the custodian and administrator. So it's going to be those institutions ultimately working on behalf of that client, allowing them to invest into wonderful private equity deals in the syndication world and many other assets as well. It really is going to boil down to who is ultimately directing those assets as a custodian and administrator.
So this question comes all the time. I'm going to ask you that too. How come there's bigger shops like Schwab or Fidelity or Merrill Lynch? Why don't they offer this kind of custodianship for their investors?
Yeah, that's a really great question, Vinky. And I'll even actually see some institutions go so far as to say that they do have self-directed investments, and they'll actually give you a menu that you can pick from. But for some reason, the menu is only mutual funds, treasuries, and CD bonds. maybe I don't want that. Maybe I want a nice juicy filet mignon steak over here, which would be that syndication investment, right? So one, it's not in their business model. We differ drastically as a custodian in that we don't have assets under management, so we're not a fiduciary as those other custodians are, and there's not a financial incentive for us to go ahead and manage those assets, which is really why we focus on delivering value to our clients, and that's unlocking opportunities for them to invest and providing that vehicle into which they ultimately can go ahead and direct their assets. I mean, we even have other institutions, some of those larger custodians reach out to us. Maybe they did 30 or 40 years ago accept self-directed assets, but now it's completely divulged from their business model. It's something that is just an administrative burden from them, and something that they absolutely have no interest in helping assist investors.
So what type of investments can someone make with the self-directed IRA? I'm saying IRA, I'm saying it wrong. So self-directed IRA, that wouldn't be possible with a traditional IRA.
Great question. So I know we touched on syndications. That's going to be a very popular one that a lot of my peers and I will actually work with, or those in the real estate world. So that being the first and foremost. Real estate property is another area into which investors will go ahead and use their retirement funds to invest into that they would not be able to do at a traditional custodian, and then enter the world of private equity. So I know syndications are a huge cornerstone in that, but also people looking to invest into series funding. I know med device companies have become of high interest as of late when it comes to investments, as well as technology companies with the growth of AI over the past couple of years as well have become attractive to some investors. So outside of that, we'll see investors use their retirement funds to invest into cryptocurrency, tying back into real estate, secured, unsecured notes. They'll want to play the bank and actually go ahead and lend out hard money. And then those also in the world of precious metals, those looking to invest into gold, silver, and the like with those retirement funds too. Only two classes you can invest in: art and collectibles and life insurance. Anything outside of that is fair game.
Oh, really? Oh, I thought there was like something regarding the crypto or the liquor or something like that. You
So
cannot invest in that too.
so in regards to alcohol and marijuana, that would be another one until we actually see it it if it will or will not become legal federally. I mean, that's another arena too. That is certainly a hot topic as of the past couple of years. So certainly something that our investors aren't able to invest in now, but with an ever shifting, changing legal landscape, something that I think could or could not become available in future years.
Interesting. So what would you say, who's the ideal investor for self-directed IRA?
Ooh, anybody with retirement funds, I think, would be the perfect investor for a self-directed IRA, and anybody with retirement funds who are looking to actually take control of their investment future. I think that's going to be a really big portion of it. Somebody who doesn't necessarily want to go through a third-party entity and have somebody else manage their money, but somebody who is passionate about investing and investing with people they like, know, and trust. I think that's going to be the perfect investor for a self-directed IRA. And then somebody who wants to take advantage of those tax advantages, somebody who wants to avoid capital gains tax when it comes to going ahead and making an investment with those retirement funds, and somebody who's looking to continue to build and preserve wealth, either in that tax deferred status with that traditional IRA or that tax-free status with that Roth IRA.
Interesting. So let's talk about some of the benefits of the self-directed IRA when it comes to the real estate investing. Since you mentioned that word, the magic word, real estate investing.
Yeah, so as it comes to investing in real estate, we'll actually see another product commonly used when it comes to real estate investing. That would be a checkbook IRA, and that would be structured a little bit different than a self-directed IRA in regards that an LLC would actually fit into it as well. Now, this would be a manager-managed LLC, thus giving the manager, being the owner of that IRA, full autonomy to be able to endorse on behalf of that LLC, but it would have a sole member, that being the IRA. And we'll commonly see that used for real estate property in regards to Say for instance, I purchase a property with my checkbook IRA, and I want to ensure I'm protecting myself personally and all my personal assets. I would certainly want that limited liability company veil in there to protect me if I do have tenants in there in case anything were to happen awry. Always great to have that mechanism in place to protect yourself personally when it comes to any investment.
Interesting. So can you explain, what exactly checkbook control IRA is and how it fits within the framework of self-directed IRA?
Yes, so this is definitely a service that we offer through Equity Doc Prep. I would heavily encourage those who are interested in it to leverage our services as compared to going off on their own and trying to create their own LLC, primarily because you will actually need to create a new LLC. So in regards to that, you will need a completely new entity. You can't use an LLC that's previously had business use for it before. But we would actually help assist in going ahead and getting that LLC off the ground, going ahead and getting an operating agreement established, getting articles of organization, ensuring that we can go ahead and get the EIN registered, do the initial state filing, and now, as of late, do a beneficial ownership form. I know that's become a new part of the game as well. So ensuring that we could go ahead, get that LLC established, as well as a checking account to where somebody could freely invest. With transaction speed. I know we're on the topic of real estate here, so let's use, for example, an auction. If you're at an auction, you're not going to be able to get your custodian on the phone and have funds wired within 30 minutes. It's not feasible, and that's really where we see a huge benefit in that checkbook IRA is being able to have bidding power in a seat. And as it comes to structuring deals in real estate, there's a lot of power to being able to write a check on site. So it really helps empower our investors in regards to being able to move their funds in a freely forming fashion. Now, how it would be structured, you would go ahead, contribute to a self-directed IRA here, do a rollover or transfer. After we receive funds, we'd help you with the LLC creation, move funds from our institution to that LLC to where you could ultimately go ahead and make those real estate investments.
Interesting. That's the flexibility basically, but you have to remember that, wherever the money comes out from, the money goes back in there so that you're not paying any taxes or penalties on that because since it's your retirement fund. So what additional flexibility does this checkbook IRA provides, and then any extra risk that you need to be aware of? I know something happened this year was BOIR, so filing. So I'm not sure if you can talk about that too, and tell us a little bit more about that, because some of the investors who have their EQRP or they have the checkbook control IRA accounts, they have to do this BOIR filing, and they feel like this is like an additional step. And then plus, I don't even know how update you need to be on the yearly basis or something like that. So some people, they don't like it that much. That's the reason they just wanted to maybe work outside of this checkbook control LLC and just have the custodian just check their paperwork and sign for them and wire the money in. So if you can talk about that.
Would absolutely love to. So going back to benefits, LLC protection, transaction speed, and that bank account connectivity. Those are going to be the three pillars that really make for a great reason to get a checkbook IRA. In regards to that beneficial ownership report, certainly something we can help handle, and certainly something we've handled for many, many clients. So that's something we have great experience in. I know there's uncertainty in doing something for the first time, so I would certainly recommend that people who are interested would reach out to us and have us perform that service for them. And then I want to make sure we can cover risks as well when it comes to a checkbook IRA, because there are certain considerations to take into account. First and foremost is who you're going to be transacting with, ensuring you're not doing any business with disqualified parties. So as it applies to an IRA, let's use an example here for myself, and you'll want to make sure to write these groups down here, is I'm going to be prohibited to my own IRA. So is my spouse. So are any of my direct ancestors, so my parents, my grandparents, any of my direct descendants, so my children, even their marriages, and then ultimately their descendants too. So I'm not able to buy or sell property to those groups, something really important to keep in mind of. And then ensuring that I'm not doing any self-dealing, so that I'm not doing a straw deal where I sell my IRA's holding to myself personally, Now, there is ultimately a way around that. It's known as an in-kind distribution. After age 59 and a half, you could start deeding assets over to your name personally. But keep in mind, if it's a traditional IRA where you haven't paid taxes, this will create a taxable event. So something to be important and to be aware of, but another tool in your tool belt when it comes to exit strategies later in life. Handling of funds is very important, and I've heard heartbreaking stories of people who have wrongfully commingled funds. Just because you have a bank account doesn't mean that you can freely, willy-nilly spend it on personal things.
I
Very,
know.
very important. So, like, say for example, I do have that checkbook IRA, and this is a very sad story that I've once heard told, but ultimately, say I'm out for lunch and I'm with my beautiful daughter. If I go ahead and I use that business account that is tied to my retirement funds, and I go ahead and purchase a cheeseburger for my daughter and I to enjoy, that would be misappropriating funds, right? And then say I put that $33 I spent back into that account of my personal funds, that could create an early forced distribution. And if you're not age 59 and a half, you're paying excessive penalties on that. So it's very important that while you're going ahead and considering a checkbook IRA, that you're not misappropriating funds, that you're not putting personal funds into the account, and that you're using it appropriately as it was designed to, which is to invest with your retirement. So very, very important to ensure that it's being used for the correct reasons and in the right scenarios. And then the individual responsibility, I would say as well, Vinki, is important to understand while using this checkbook IRA. Ultimately, that account owner is going to be responsible for all investing decisions. So ensuring that they're asking the right questions when working with those who they're going to be investing with, and then also the personal oversight. I mean, they're going to have to do the accounting for that checkbook IRA. Doesn't mean they need to be an accountant, but they need to keep a ledger. You need to be organized. You need to know exactly what you're investing into, what you're investing out from, and ensuring that those debits and credits are appropriately allocated, because ultimately that accounting will need to be performed by that IRA manager.
Interesting. That's what I was saying earlier. You have to be careful. Wherever the money comes out from goes back into the same account just for the investment purposes, not for the personal use. That's the biggest caveat in the self-directed IRA account. I mean, from experience, I can talk about that. And then let's move on to 1031 exchange, because
Yes.
1031 is another way, is I would say, tax strategy and also investment strategy. So for some of the listeners who might be unfamiliar with this term, 1031
Yes.
exchange, can you talk about that a little bit? How does that work in real estate?
Oh, I would absolutely love to. So here at As Equity, 1031 Exchange, I mean, we've been a qualified intermediary for over 25 years. I personally have helped clients who have 1031 Exchange properties in the hundreds of thousands of dollars, whether it be raw land, even up to tens of millions of dollars when it comes to apartment complexes up in the Northeast. So it can be used for smaller real estate sales and purchases, or very large real estate sales or reinvestments. But what a 1031 exchange is it's actually a tax provision that was introduced to the United States in 1954, and it's going to live in, hence the name 1031. It's going to live in the Internal Revenue Code section 1031, and it is a tax deferred strategy that's going to be used commonly by real estate investors to ultimately defer that recognition of capital gains from the sale of real estate property when another property is purchased. Now, while moving in and considering at 1031 exchanges, there's going to be 5 basic rules to that 1031 exchange that you're going to want to keep in mind. And I want to make sure I can cover those today. The first one is going to be the net selling rule. The second one is going to be like-kind investment real estate. The third one is a qualified intermediary, which would be our role in that exchange. And then there's 2 other rules I want to go through as well. One known as the 45-day rule, one known as the 180-day rule. So you'll want to make sure you write this down with the net selling price, because it's going to be the magic number when it comes to going ahead and doing a 1031 exchange. It's going to be that gross selling price of the property that you're going to be relinquishing in that 1031 exchange. And you're going to take that and actually subtract those closing costs. So any sales commissions, title costs, doc stamps, and any of those miscellaneous expenses that are really important for closing and are pertinent, you're going to subtract those to get that net selling price. And that net selling price is what you're ultimately going to need to go ahead and use and reinvest into that replacement property to be able to fully defer those capital gains taxes on your sale. Now, I want to make sure I can touch on what is like-kind property and what does it mean. It
Can I
is,
ask you one question before
please,
that?
please, Vinki.
So when you say deduct all the expenses, can you pay yourself for all the work that you did for the selling, like finding the buyer or going through the whole process? Because it needs time and you're spending your time to make this happen for you. Is there any way you can pay something to yourself in this whole exchange process?
If your CPA blesses it, so if your certified public accountant's on board, and if it's pertinent to closing costs, it can be done. But really important to get that CPA's blessing, and that's something that I want to make sure I can touch on today. Is it is very important while moving through the exchange that you do have somebody that you can count on, because these 1031 exchanges, ultimately we're going to be talking about a significant amount of money to an investor, and you're going to want to ensure that as you move through this, that it aligns with what you're doing on a personal standpoint as well. I mean, nobody knows your tax situation better than your CPA, so it's going to be important that they're involved in this process as well with us as that qualified intermediary, as your realtor as well. I mean, sometimes these 1031 exchanges can get down to the wire, and sometimes people actually realize and understand the concept of a 1031 very, very close to closing. So sometimes I will have clients who are trying to drink from a fire hose in a very limited amount of time, which is why I want to make sure that I'm always a reliable resource for them and ensuring they're getting the correct education and materials so that it can be easily digestible if there are one of those 2 time windows coming up against the clock that we'll get into here in a little bit.
Interesting. Okay, so let's move on to the like-kind property, number 2.
Yeah, so in like-kind property, very, very broad term, and there's a misconception in our industry, Vinki, and I'll be the first one to go out and call that out here. A lot of people think that, hey, if I'm relinquishing and I'm selling farmland, well, then I need to reinvest into farmland because that's like-kind, and that's what I have to do to be able to go ahead and move forward in this 1031 exchange, and that simply isn't true. For it to be considered like-kind, both properties need to be held for investment or business use. That's what like-kind property means, is real interest in real property. So that is a very common misconception that we'll see thrown around in our industry that I want to make sure to clear up for those listening here today on the podcast. Like-kind is a very broad definition. Once again, it needs to be held for investment or business use. Now, what is a qualified intermediary? That's ultimately going to be our role here as the QI. It's going to be that independent third party that's going to be required by the IRS, very similar to our role as a custodian administrator. You need to use one. It's not a if, then, or can I. Full stop, you need a qualified intermediary. You need that unbiased third party to be able to complete that exchange and escrow those funds. Now, who can't be that qualified intermediary? First and foremost, the taxpayer, the one with the skin in the game, right? There's certainly a conflict of interest there. And then any agent of that taxpayer. So we're talking realtor, attorney, tax advisor, banker, accountant, employee. If they're an agent or associated as an agent to that party, to that taxpayer, they're not going to be able to be that qualified intermediary as well. And then any lineal descendants. So any children, any grandchildren, and thus force aren't able to be that QI. And then something else I really wanted to get in today, 4 and 5, are those time windows too, because this is what I see as one of the most important things when it comes to a 1031 exchange, is understanding these time windows and understanding the importance of them, full stop. In regards to the 45-day rule, that's going to be identifying property. So once when you've closed, you have 45 days from that initial closing to identify to the qualified intermediary in writing that the property is going to be relinquished. So something very important that you're going to need to do is you're going to need to identify those properties. After that 45-day window, full stop, none of those properties can get swapped out. No more properties can be listed. So very important that while you're considering doing a 1031 exchange on the front half, that you're already cognizantly searching the marketplace, working with a realtor, working with a professional like yourself, Vinki, to start locating where can I redeploy this capital. because it doesn't necessarily need to be into an actual real estate property investment. It could be a tenancy in common situation with a syndication. It could be a Delaware statutory trust that you reinvest into. It doesn't necessarily need to be a single plot. There are other options out there. So something I always encourage people when I first meet them and when I first get to speak with them about 1031 exchanges is, have you started the process of identifying that replacement property? And if not, I would encourage you to highly take urgency and get started, because 45 days doesn't sound like a lot, but we're talking 45 days including weekends, 45 days including holidays.
Sure.
Time goes by quickly in the real estate world, so it's very important that they're understanding that they need to get moving on those replacements. Now, there's a few different rules they could use when it comes to identifying replacements. One being the 3 property rule. They could list any 3 properties regardless of their fair market value. So pretty straightforward. You could name 3 replacements. The other one is going to be the 200% rule. Now, say I'm selling a property with a net selling price of $1 million. Well, if I'm using the 200% rule, I can list any number of properties so long as their aggregate sum doesn't exceed 200% of the property I'm selling. So I could list as many as I want in this example, so long as I'm not listing $2 million or more worth of value amongst those real estate properties. So definitely something to be aware of, as well as you have options when it comes to different rules, when it comes to moving forward and identifying those properties. And then the 180-day rule. You have 180.
So you find the property in first 45 days, and then you have 108 days to close it, right?
You got it. And that 180 days, that 45 days will count towards that 100-day window. So both of those 2 clocks are going to start immediately upon that day of closing. So very important that you're buttoned up when it comes to the 180-day window, because it is full stop. It does not matter what holiday the 180th day falls on. It doesn't matter if the post office isn't open, if it's a federal holiday, what have you. So very important that you have those T's crossed and those I's dotted when it comes to executing that secondary closing, because that is what will need to happen. Is the exchange will need to be completed, and you will need to go ahead and have that replacement property outlined when moving forward and in completing that exchange in that 180-day window.
So what if, let's say, you identify the property in first 45 days and you're super hard about it, I'm going to get it, this and that. But things happen sometimes. So what if the deal didn't go through? So what happens? 45-day period is up. So now you're stuck paying taxes, or is there any exceptions out there?
So if you're not able to identify the property within 45 days, or you're not able to complete the exchange in 180 days, Vinki, you're exactly right. That sale's already occurred on your property, you're going to be subject to those capital gains taxes, which is very important to be aware of while going down this venture, is ensuring that at worst case scenario, if you don't identify those properties, let's say I identified 3 properties, 2 of them already closed, and one I found structural issues in the home during an inspection, and there's no way I want to close on that, regardless of deferring capital gains taxes or not. Just very important as you're navigating through that process that you know what you're going to be replacing into, and ultimately how you'll be proceeding forward, because you're exactly right, Vinki. You would be subject to the capital gains taxes at that point and would be on the hook for that tax bill.
So let me get this straight then. So this is not 45 days, like 180 days altogether that you have. You can identify the property, but you have 180 days to work with. As long as you close this before 180 days, you are in good shape, right?
Yes, you have the full 180 days to complete.
180 days, because it's altogether 180 days. It's not exactly 45 days, the cutoff time. Okay.
The 45, the 45 will just be to identify. So the 180, you got the full 6 months time frame to actually go ahead and close in the replacement. Just important that you nominate those replacement properties in that 45-day window. But there's also certainly other rules to be aware of as well.
Obviously. So what are some of the other common pitfalls or mistakes investors make during this 1031 and end up paying taxes even though they're trying to avoid it?
Great question. Really great question, Vinky. So vacation property is somewhere that I see where things can go awry and
Uh-huh.
something to be very cognizant of while you're going ahead and performing an exchange.
Mm-hmm.
I have people ask me all the time, does vacation property qualify towards a 1031 exchange? And vacation rentals will qualify for 1031 exchanges if they meet the rules of the revenue procedure in 2008/16, which is going to be the property needs to be rented out for at least 2 years before its sale. So it needs to be Airbnb, verboed. You need to have a tenant in there. Whatever that situation looks like, it needs to be rented out for that 2-year holding period.
Mm-hmm.
And then the replacement property needs to be rented for at least 2 years after its purchase.
Mm-hmm.
And the most important part here, personal use cannot exceed 14 days or 10% of the days rented out each year during this 4-year period. So very important that one, either they use the property very sparingly, they still can vacation there, that's okay, but they can vacation there more than 14 days a year. So very important, if you do plan on using it personally, you do so at a very select time in very minimal circumstances, or 10% of the time it's rented out. Say you rent it out quite frequently, well then you're going to be able to use it a little bit more personally. But something to be aware of while going ahead and completing these is ensuring that it's investment. That's something
It is.
that I think too many people lose sight of all the time. Is we all get very excited about deferring capital gains taxes, rightfully so. Rightfully so. We want to use that money to reinvest, of course. But we also need to be very cognizant of the fact that this is an investment property, that this tax provision is for investment properties, not necessarily personal properties, but investment properties.
So you cannot mix that two, basically. So let me ask you the key question here, since we're talking about the self-directed IRA account, and then we were talking about a 1031 exchange. So is it possible to combine your self-directed IRA with the 1031
Yeah.
exchanges? And what is the advantage, or what is the approach?
Yeah, it could certainly be done. In terms of advantage, it ultimately, Vinky, is a little bit redundant in the fact that you're already deferring those capital gains taxes with the retirement account. Where I see it most commonly used is another way to add capital into an offering or into a deal. But in terms of the actual advantages, I mean, you're already deferring capital gains taxes in that self-directed IRA. So we'll see it used from time to time. It is not common by any means, since that self-directed IRA already checks that big box.
Already taking care, checking all the boxes. So you do not necessarily need to look for the 1031 exchange within your retirement plan. You can find any other property, or if you're part of the syndication, you can invest. There's no time limitation of 140 days, right? That's the only thing I wanted to validate with you.
For the self-directed IRA?
For the self-directed
Right.
IRA.
Yep. So
Okay.
with that self-directed IRA, they'll be the same exact 45 days identification, 180. You're subjecting yourself to a lot more intricacies and additional rules without necessarily seeing the
You
direct
don't need all that.
right, without necessarily seeing the direct advantages, because you're already deferring those capital gains taxes. But that was
Exactly.
a very good question. Other important information as it pertains to a 1031 exchange is titling. It's important that however that relinquished property is titled is going to be how that replacement property is titled. That's definitely something important to be aware of. If I own the property in my LLC, it's important that that same LLC purchases the property I replace into. Other things to be aware of: no fix and flips, right? We need that 2-year holding period. So you're not able to go ahead and in 6 months buy a property, fix it all up, and then think you're going to defer all the capital gains taxes within that same calendar year. Cannot be done. And then the exchange must be in place prior to closing on the sale, Vinky. I have seen so many heartbreaking moments, so many testimonials of people giving me a call. Hey, I just closed on my property. I just sold it. I'm ready to do a 1031 now. Woohoo! Let's defer these taxes. You're exactly right. The clock's already started. The game's begun. You're still in the locker room, putting on your uniform and buttoning up, and the game's already started. So that's something I would always encourage everybody to to gain information, to seek education, to pursue resources before that closing, because when that door shuts, it's shut. There's no magical way that I can somehow rip the hinges off and ultimately get you back in the game, because it's already been started. You're already off to the races, and by that point, that 1031 exchange isn't able to be embarked upon. So something I would always encourage everybody to do before you close is ensure you're taking advantage of all the tax situations you can.
Wow, I love that how you explain in very detail everything. So let's talk about the market. So how do you see the current market conditions are
Mm,
impacting these strategies, whether it's
mm,
1031 or the self-directed
mm.
IRA? What's going on?
Oh,
Tell us a little about that.
great question, Vinki. Really great question. I constantly see people move markets. That's something that I see very commonly. So, just a couple months ago, I helped a family up in the Northeast area move out of an apartment complex into multiple single-family homes that they're going to be Airbnb in the near future, and they wanted to move. They wanted to move markets. They had been invested into the Northeast for many years, for over 50 years actually. So they've been there for quite some time, and they saw greener pastures. So that's going to
Mhm,
be a huge reason on to why people 1031 exchange and why they sell, is because they believe another market is performing better. In this
mhm,
case, they had replaced properties into Florida, as I mentioned earlier. But moving markets is a huge strategy that I see being used. Is going to a hotter market, or going to a market that people believe will become hot. It necessarily isn't hot now, but it will be soon. And I'm even seeing that here in the Midwest as well. I mean, due to the affordability, I'm speaking to you here in Sioux Falls, South Dakota, and Midwest is known for its affordability because of these white little flakes that show up in December and January, and turn into huge piles on people's driveways, and cause immense back pain and heart palpitations. Um, there's a number of factors of affordability here in the Midwest, but I'll constantly see people end up replacing here because they believe it is an area that they'll see great returns in the future. Another reason is to acquire less management intense property. I mean, we're currently in the day and era of the a huge transfer of wealth that's going to be happening in the baby boomer generation, and it's going to be the greatest generation of wealth that I've seen in my lifetime. Um,
mhm.
and and as people continue to age, they don't want to have a humongous door count. I mean, I'll use the gentleman in the family that I helped up in the Northeast. They had over 100 doors in an apartment complex. They didn't want to deal with it anymore. They had the property management lined up. They were seg costing and ensuring that all the boxes were checked, and they were tired of playing the game. I mean, they didn't
Right.
they didn't want to deal with the property management headaches. They wanted to acquire less management intense property, and eliminate that headache for themselves and their family in the future, while doing some estate planning as well and getting a stepped up basis. Ultimately, that's a huge reason that a lot of attorneys will give us calls as well to help their clients, is to ensure that as they're doing estate planning, that they're not leaving their heirs with a with a big cost after
Right.
after they pass, is to ensure that their kids can get a stepped up basis, that they're not paying the taxes on that property, which is another huge reason that people will go ahead and invoke a 1031 exchange. But tons of other strategies to consolidate. If you have multiple holdings, you want to move from multiple properties into one, or you want to move into one property to multiple, and then even acquiring property with greater income potential. I mean, we'll see people move from vacant land, large farm families who want to move from vacant land and hedge and diversify. Say they're sitting on thousands of acres here in the Midwest. We'll constantly see them break that into reinvestments, into residential, into commercial, into mixed use, and just continue to hedge and not necessarily have all their eggs in one basket.
Interesting. Thank you so much. I mean, oh my God, I have a bunch more questions, but we are out of time. We actually over time. So at this point, share one golden nugget with my audience. It
Yeah,
could be something around what would be the best advice for my listeners on 1031 or self-directed IRA.
I'm going to tie it back here to the stepped up basis. I think that is a humongous advantage that many people are unaware of, or they overlook when it comes to estate planning. I think that if you are in the point of your life where you're drafting a will, or you
Mhm.
are consulting with an attorney about estate planning, I think it is a wonderful time. If you are sitting on real estate investment property to potentially consider a 1031 exchange to help out your heirs. I think that is a real good golden nugget.
Thank you so much. So this brings us to our why rapid fire round. I'm going to be asking you 5 questions. You have to answer it in 1 word or 1 sentence only, spontaneous answers. Are you ready?
Mm-hmm.
All right. So what is one of the most important thing that you have learned in your life, and how did your life change after learning it?
If it is to be, it is up to me. I think
I love that.
I think that would fit it, and I think it's changed my life immensely. I think it's heightened my sense of urgency. It's allowed me to take action, and ultimately knowing that if I'm not the one who's going to be responsible for it, it may or may not get done.
Wow, that's really good, I think, because a lot of times we do not have that awareness, we just kind of finger pointing all our life without realizing that this is it. I love that. Thank you. Share one good book that you would like to recommend to my audience.
Simon Sinek, which is Start With Why. That would definitely be the book that I would recommend. How Great Leaders Inspire Everyone to Take Action. I really enjoyed his book. Ultimately, people don't take action until they know why.
That's true. Because I think it's like they're kind of get cooped up in how, basically, more than what and why. So if you can figure out your what and why, you'll figure out your GPS, the how.
You're exactly right. If they know their why, they're going to take action. They're going to figure out how.
It's important, right? What and why is more important than how. But everybody, I see people get entangled in how all the time. Okay. In 1 word, what does life mean to you?
Life is about investing time with my family and making the right personal investments, whether that's in my career, whether that's working for my employer, whether that's investing into a real estate deal so that I can actually invest that most important commodity, my time with my family, most definitely.
Oh, I love that. I love that. That's awesome. What is your biggest passion? I know
Uh,
one, but other than that,
I
that's your daughters, right?
it is. It is. I can't no, you're exactly right. My daughters would be my biggest passion. Outside of that, I love sports. I participate in a basketball league every Saturday morning, and I aspire one day to help coach my daughters when they get older and be a part of that.
Nice. That's really good. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
I would tell myself to start investing earlier. I think that is
Oh,
is certainly something I would tell myself is due to inflation and having dry powder on the sideline. I mean, our buying power continually decreases over time, and it continually will as the Fed continues to print money. So I would have told younger Paul to invest early and often, and to definitely put it in a Roth IRA account, pay that tax on that seed then and there, and then enjoy those tax-free returns later in life.
awesome. I love that answer. So tell me, how can people reach out to you?
Yeah, people can reach out to me via my direct cell phone number. That is 605-799-8620.
Thank you so much, Paul. I really enjoyed our conversation today.
I really appreciate your time today, Vinki. It was an absolute joy to be here on your podcast today, and I will continue to enjoy listening to many more episodes in the future.
Thanks.